Am I sharing my screen? Yeah. All right. Today's agenda. Fed independence, gold and silver next move. We talked a lot about yesterday. Look, if there is a lot about yesterday. Mute those. All right, there we go. Talked a lot about gold and silver yesterday, how there was really no bullish play, right? With implied volatility where it was, options are super expensive. Buying call spreads, I mean, you had to go way out of the money and really spread out the strikes just to get any benefit from skew. And there just wasn't really a bullish move. And so the idea being is that the gamma squeeze, right? The expanding, credit within gold and silver trades called margin and leverage, it was really prime for a deleveraging. So we'll take another look at gold and silver today. We'll talk about Fed independence, and I'm going to share with you a VZ earnings butterfly recap. So I saw this pop up yesterday. I saw it late, with about 25 minutes to close. So I shared it in our Ghost chat. I shared it also in our Ghost Signals chat as well for those that wanted to trade it, and some did in Ghost Prints. But I kind of want to recap this because it's on the heels of a number of earnings trades that I didn't trade Oracle, but a number of our Ghost Print members did and did phenomenally well on that one. Over a 200% gain on that one. But we traded Nike. I traded recently VFC this week that I shared with you guys, VZ yesterday. But using Ghost Prints for earnings moves, just kind of make it, how do I use big prints to be able to set up earnings butterfly trades or any sort of earnings trade? I just did an earnings butterfly gun on VZ. Now, that butterfly, if you didn't get out this morning, it's blowing out right now because VZ's really running. And that's when we're talking about using Ghost Prints for earnings moves. It's important, right? We've talked about the difference this week between a gamma wall and a gamma squeeze. And right now it's happening in VZ. We're seeing a gamma squeeze, but we gapped and traded at the level we needed to. And we'll kind of talk about that. All right. So let's talk about Fed independence here for just a moment. And so for this, I'm going to bring up the 3-month T-bill. So IRX:CGI. Now, why am I bringing up the 3-month T-bill? Because this reflects the Fed funds rate, right? The Federal Reserve has the greatest impact on short-term rates, not long-term rates. Long-term yields like 10, 20, 30-year bonds are based more on inflation expectations and not on Fed policy, to the extent that Fed policy doesn't reshape those expectations. I'm going to back this out here. Let's go out 10-year weekly, okay? So we can see when the Fed is cutting rates. We can see when the Fed is raising rates. Now, the Fed back here in 2019, right? 2019 began to kind of cut rates. We're around 2.5%. We cut rates here going into the end of 2019. September, somewhere right around here, the Fed launched their reverse repo operation. They launched their reverse repo operation. The Fed here, this was Powell, decided to raise rates one last time, right? And then quickly reverse policy by the end of the year as the market sold off. So the question becomes, is the Fed independent? Who owns the Fed? Who owns the Federal Reserve? What do we think? Who owns the Federal Reserve? Banks do, right? We have big member banks. So the banks own the Fed. So the Fed is a large private bank, but they've been given monopoly power by the federal government to print a currency, right? Print notes. It's called the Federal Reserve note. It's called the dollar. What backs the dollar, Chinese? What backs the dollar? So the Federal Reserve's printing notes called US dollars. What backs the dollar? Treasuries? Nope. Gob? Okay. The Fed is the blank checkbook. Yeah. Power. Okay. So there is nothing backing the dollar, right? There's zero, zip, zilch, but you can buy US assets with it, right? But here's the deal. Why does a dollar that's backed by nothing have any sort of value? Called fiat, right? So what we've done was, because we've given them monopoly power, we've also by fiat, by command, said you have to accept dollars for all that's public and private. Okay. Yeah, I'm going to get to that, Fate. All right. So at this stage, through the threat of violence, you have to accept dollars. Unless COVID, then you didn't have to accept dollars, right? Except for digital. So the problem is, it's not about faith. It's about what? It's about power. It's about directing everyone that you have to accept dollars, right? So at the end of the day, it's why we call it a fiat currency, right? There's zero backing. We're saying you have to take it, otherwise you're going to go to jail, right? And so that's allowing the dollar to have some sort of value. Now, there is more backing this, right? Because it is a claim on future production in the United States. It's a claim on U.S. assets that are denominated in dollars, or anything denominated or traded in dollars. So the idea being is that we do have an infrastructure built around dollars, right? You can buy treasuries and get a yield. You can invest in U.S. stocks. You can engage in U.S. markets by using dollars. And so we do have the most complex and deep financial system in the world that was established because of that, right? But that was not built originally on that. So when we go back to, let's say, 1930s, what could you do with a dollar? At that point, prior to 1933, you could take your dollar, right? And you could exchange it for what? So you could take your dollars, in this case, $22. That was what the gold price was set at prior to 1933. Yeah, you could take $22 and exchange it for an ounce of gold. Now, if we go back to 1933, at that point in time, would there be kind of a maybe a desire as a U.S. citizen to maybe hold gold over dollars? What do you think? There was a fixed exchange rate between $22 an ounce in gold. It was real money. Okay, but could you argue that if the dollar is convertible to gold, that it's real money? Absolutely, right? But gold in and of itself is money. It's not a commodity. And that's why I was getting chat earlier today. When if people say gold's a commodity and gold is money, run away. They have no idea what they're talking about. Okay. But $22 an ounce, you could buy an ounce of gold. It was a fixed exchange rate. Why did we engage in a fixed exchange rate and be able to convert $22 an ounce for one ounce of gold? Why was it fixed? It was a control on somebody. It was a control on the Federal Reserve to do what? To control the monetization, right? To control printing. We had a fractional reserve system. What is a fractional reserve? Fractional reserve is they print more money than they have gold in store. And what happens is, when that gets out of balance and suddenly we have a lot more dollars than gold, what happens? Gold flies off the shelf. But the fixed exchange rate, the promise that if you take a dollar, you can convert $22 for an ounce of gold prior to the 1933 legislation. Okay, it was fixed. The fixed exchange rate was ultimately a way to keep the Fed from creating too much inflation or expanding the money supply too greatly. Now, how does the Fed increase the money supply? It's through debt, right? It's rising debt is how the Fed increased the money supply. They give monetary stock to the banks, and banks lend it out potentially upwards of 10 to 1. Now, guess what? Banks don't have to hold any reserves anymore for checking or savings. They've never had to for checking, or they've never had to for savings or CDs, that kind of stuff. That just went out the door in the form of investment or debt, right? They did have to hold 10% in demand deposits, but back in 2021, they basically, you don't have to hold those either. So what happened was the Fed was engaged in significant monetary expansion. There was significant risk by U.S. and global holders or foreign holders of our dollars to what? Run on the bank and take the gold. Okay? And say, look, we don't want dollars. You just printed tons of dollars. You have a fractional reserve system. We're not concerned about price stability. In fact, that was the Fed's original mandate, right? They wanted price stability. But guess what? They didn't maintain it, right? 1929 crash is a great example. They're funneling money out the door to who? Stock jobbers, right? Go back to, like, the old Dutch, in French inflation leading to stock jobbers back in the 17, 1800s. But again, same scenario here, right? They expanded they expanded the monetary base, and it ultimately expanded the money supply. It led to a massive, massive bubble going into 1929, and we're experiencing a crash. People don't want to hold dollars; they want to hold gold. If you're a foreign, if you're U.S., you want to potentially exchange those dollars for gold. So, what did FDR do as a solution? So, we're talking about Fed independence here, right? What did FDR's administration do? This was before Bretton Woods. Gold convertibility was for $22, guaranteed, right? Guaranteed. FDR came in and said, U.S. holders of gold, you cannot hold gold. You're going to sell your gold to who? You're going to sell your gold to the Fed, right? So we're going to confiscate all of your gold at $22 an ounce, and we're going to hand it over to the Fed and exchange it for them, right? Now, what did they do on top of that? Once they gave the gold to the Fed, they reduced the exchange rate. They upped it. Now it took $33. Think about that for a second. They raised the exchange rate by $11. We just devalued our currency significantly, right? FDR was probably a complete disaster on almost every single front, right? Now, but what was Nixon's problem, right? So here we defaulted, right? In effect, we raised the exchange rate. We stole U.S. holders. We said, look, you can no longer convert gold to dollars to gold, but foreign holders of our dollars can. But you can't do it at $20. You're going to have to do it, I believe, at $33. Okay? So now all of a sudden we just devalue our currency. We create massive inflation for who? For U.S. holders of dollars. Now their dollars are worth significantly less than they were previously. Tell me there was Fed independence. There's not. There never has been. So if you want to talk about the Fed today, you're completely ignoring major points in history. So in the 1960s, what was the Fed mandate in 1960s? What was the Fed mandate? Did they have a dual mandate yet? Nope. Their singular mandate was a stable prices. Again, remember, we just raised, and we also had a Bretton Woods agreement, right? We had an agreement with the rest of the world that you could exchange your dollars for gold at a fixed, $33 exchange rate. We promised, right? Post-World War II reconstruction, you take dollars, you can convert it to gold for $33 an ounce. The Fed's mandate is price stability. And what do they do in the 1960s? Remember, we have a fractional reserve system, right? We do not have a gold standard. All we had for a gold standard is convertibility. And we engaged in Bretton Woods and said, yes, hold dollars because you can convert it to gold if you needed to. But we still have this fractional reserve system. The Fed is not tied, right? Is not tied to a gold standard and never has been. It was always about gold convertibility, maintaining stable prices. But in the 1960s, and particularly the later 1960s, we began to engage in substantial expansion in government spending. So what did the Fed do in tow? They printed massive amounts of money in response to the massive expansion in government debt in the 1960s. So much so when Nixon was in office in 1971, we were jeopardized because guess what? All of the gold was going to go off the shelves at $33 an ounce because the Fed had printed massive amounts of money. Why? To support the government. Tell me there's Fed independence. There is none. Zip, zilch. Now, Nixon was faced with a challenge. Do we start to reduce the balance sheet of the Fed, rein in the money supply, and all the consequences that go along with that? No, he punted. He suspended the gold window, and they killed it in 1973. Okay? Again, defaulting, didn't we? We had an agreement. $33 an ounce, exchangeable for gold. Nope and nope. Is that Fed? Who are we trying to protect there? We're trying to protect who? The Federal Reserve, because they made massive, massive policy mistakes. The Federal Reserve is one policy mistake after another. My degree's in economics. Do you think I learned anything about theory? No. Theory was what? An elective. So if you're an economics major and you want to take an economic theory class, it's an elective. Everything is rote, right? Now let's fast forward today. Trump's been in office for 1 year. Has the Fed's policy been accommodative or restrictive? A little bit of catch-22. Vietnam got in the way, but it was before Vietnam, right? But certainly Vietnam was a cause, right? War has always been a means of creating inflation, right? When people won't accept just printing of money and expanding the money supply and inflation, they'll typically be okay with inflation because of war, as long as people still support it, right? Vietnam, people began not to support it, right? Has the Fed policy been accommodative or restrictive during the Trump administration? So as the Fed policy, so the Fed began cutting rates right here, right? 5.25%, 5.5%. They cut it back to about 4.25% to 4.5% here. That was before Trump took office and we flatlined. All right. Oh, yeah. INP Myers has it. It was actually both. Initially, when Trump took office, inflation was higher, right? It was higher. Initially, it was slightly accommodative, but as inflation came down, it became restrictive, and currently at 3.5%, it's restrictive. So if the Fed is engaging in restrictive monetary policy, and we have some of the highest interest rates in the world, what should the dollar be doing? So if we're engaging in restrictive monetary policy and we have some of the highest interest rates in the world, what should the dollar do? Dollar should be going up, right? Trump wants higher inflation. Trump doesn't want higher inflation, right? Admit it. Trump absolutely does not want higher inflation. Okay. So we have to kind of understand the rhetoric, right? So when inflation was really hot back here, why did the Fed cut rates? Why did the Fed cut rates in 2024? Is that independence? Absolutely not. Why did the Fed raise rates here? Is that Fed independence? Absolutely not. Why did the Fed go from 0 to 5.25% to 5.5% in 2022? What sparked that? The Fed's balance sheet, the BS, right? They weren't reducing the size of their balance sheet. What about the reverse repos? The repo facility, they weren't reducing those back here. All of the mechanisms that are designed to expand the money supply weren't happening back here. They're at zero interest rate policy in effect. Why suddenly raise their rates from 0 to 5.25%, 5.5%, while maintaining your balance sheet, while maintaining all the liquidity facilities for all of the banks and big companies in the United States? Why did the Fed bail out the biggest companies back here in 2021? Why did they say when Ford Motor Company had their bonds declared as junk, their rating, did they launch a program to buy junk bonds with Ford's date and earlier, nothing after? At the end of the day, the U.S. companies made significant amount of money. Banks made significant amount of money right here, right? Companies were taking their debt that they took on back here and were making a ton of money. We're talking the biggest companies in the world. So what happened right here? All right, we're going to reduce rates just a teeny bit. Why? Just before an election, right? I mean, look, the Fed has never been apolitical. The Fed has always been a political animal, right? And so again, if the Fed, if Trump's going to have Warsh now become the president, guess what? It's just going to be more of the same. It doesn't matter who's in office, right? Do you think Trump supported interest rates going to 0 back here? Absolutely, he did. right? At the end of the day, every president wants lower rates. They want inflation in terms of expanding money supply. Does Trump necessarily want rising prices? No. But what is the main factor for why the dollar is losing value? Because we have to understand we have decades, okay? We have 100 plus years of policy that's been purely designed to push debt, okay? To push debt. That's what we've done. We pursued it in Trump 1, we pursued it in Biden, we pursued it back here in Obama years, we produced it every president over the last 100 plus years. It's been about debt, expanding debt, making us more of a debt-based economy. And what has that led to? 50% of our currency of US dollars are held by foreign countries, either by foreign individuals, by foreign companies, by foreign countries and central banks, etc. 50% of all dollar reserves are held abroad. Now, suddenly, for the first time in 100 years, we're trying to make a bit of a shift from a debt-based economy to a savings-based economy. And that is not without significant risks to dollar devaluation and inflation. When all of that money that we've printed over decades that's sitting abroad and that money comes back home to roost as they exchange dollars for their own currency, other assets, yada, yada, yada. So if we are going to say we want to be a savings-based nation, now, is there any evidence that we are trending towards savings? Now, savings is reflected in what? Trade deficits, right? Is there any indication, objective indication, we are trending towards a savings-based nation? People saying no. Does anyone know what our trade deficits have been the last 2 months? Or well, the last two that reported? We are running $130 billion deficits. Does anyone know what our deficit was 2 reports to go and the last one? It was like what, about 28 billion, and the last report was about 56. We have seen a significant historic reduction in our trade deficits the last 2 months. So there is significant traction here. Now, part of the trade deficit expansion there, we found out yesterday or the day before, it was about what? Capital goods coming to the United States. So we're not just seeing like foreign investment into like real estate or things like that. We're actually seeing capital goods come to the United States. Capital goods do what? It was negative again, but we've seen a substantial reduction in trade deficits. Okay. I mean, this is a material, historic reduction in trade deficits. And the $56 billion trade deficit was the result of capital good inflow, right? What do capital goods do? What do capital goods do? It's right here. It's capital goods. So if our trade deficit was a function of importing capital goods, what do we do? What are capital goods used for? They're used for production, right? What will expand our ability to produce? We need capital goods, right? We don't produce currently, right? I mean, if you want to manufacture steel right now, there's no way to do it with U.S. source capital goods. You have to go and buy foreign produced in the near term, right? But if we go back to production here, so you're saying tariffs are working? Absolutely. Now, it's not the tariffs just themselves. Does a 10 to 15% tariff change anything in terms of realigning manufacturing? The answer is, of course, no, right? 10 to 15% tariffs. I've talked to my brother extensively about this. He manufactures in many countries in Asia, and a 10 to 15% tariff will get absorbed by the manufacturer predominantly. They will absorb a 10 to 15% tariff all day long. There's zero inflation effect by a 10 to 15% tariff. Sorry. All you inflationists out there saying tariffs create inflation, no, they don't. My brother, with all of his suppliers in China and Indonesia and India, Vietnam, Philippines, every single one of those manufacturers would absorb a 10 to 15% tariff every single day of the week. And then some, right? 30% tariff, they'd probably still absorb it, So at the end of the day, what tariffs are really causing this? It's the reciprocal tariffs, right? At the end of the day, it's the reciprocal tariffs. That's what's creating this. Okay. Now, how does this relate to what's going on here, right? Don't go the original thinking saying that, oh, the Fed is independent. There are many more, much more significant points. In fact, the Fed's mandate for employment was launched in 19, well, I got it here, in 1977. There was never a consideration for employment as a means for policy until 1977. So don't tell me the Fed's independent, right? Don't tell me that suddenly the Fed's policy is different today. If not, you're just saying the Fed's been more restrictive. That if it came down to the Fed, what's moving gold and silver right now, if it came down to Fed policy, gold should be going down. Silver should be going down. Stocks should be going down. Except for what? Except for their balance sheet, still $6 trillion. There's still tons of money floating around there, even despite the fact their interest rate policy is restrictive. They have not done enough on the back end. They're still supporting business. They're still supporting banks at the expense of who? At the expense of regular old customers, right? The retail public is getting screwed right now because of interest rates. Meanwhile, everyone else is benefiting by the largesse of the Fed by maintaining the size of their balance sheet. Okay? So let's be honest. And what does Trump really want? He wants lower rates. He wants lower rates. Should he get it? 2.5%. If we take the current inflation rate, this should be 2.5%. If we take the Fed, we're taking the Fed's own projections for inflation, we should be well below 3% right now. Okay? But it's inflationary. It's only inflationary because the Fed has not reduced the size of their balance sheet. Right? The Fed's still trying to engage and provide liquidity to who? Everyone that was making a ton of money right here as they raise rates to 5.25%, 5.5%. At this stage in the game, the Fed is absolutely 100% sticking it to Joe Public, right? At the expense of who? Well, for the benefit of who? Banks and big businesses, right? They've never been independent. I totally agree, Matt. So those who argue Fed independence now were cheering interest rate cuts in 2024. It's a pure political game, right? They're trying to shape sentiment. They're not really trying to understand policy. And at the end of the day, I don't like everything that Trump's done, but the fact of the matter is, I do like the fact that we're trying to move towards a savings-based economy, and we're actually seeing little signs, although significant signs, that is turning around, and we're not in collapse. Normally, when the trade deficit drops, we're in economic collapse. We're just not importing anything. Okay? All right. So let's talk gold and silver because this does relate very directly to gold and silver right now. So we're looking at gold kind of blowing off here. And again, as we reshape, and again, I'm hopeful but not optimistic, we'll actually get to fully reshaping our economy towards savings and you'd have to get rid of the Fed anyway to get a capitalist banking system, a market-based banking system, because we don't have one now. We have a centrally controlled banking system and some Yahoo sitting in there that's an attorney, but doesn't matter if they're a PhD economist sitting there. No. What do you learn in economics degree that actually teaches you anything about real economic theory? I'll say one more thing and I'll get off the soapbox here. Milton Friedman, right? Milton Friedman blamed us sinking back in depression in 1933 because of a collapse in the money supply that they subsequently robbed people blind, right? At the end of the day, Milton Friedman also killed the economics profession. Whatever you can statistically prove, is truth, right? Theory, there is no theory, right? Theory, it does not have to be any theory. It's all statistics. It's all empirical. If you can statistically show it, it proves it is truth. Theory actually guides your statistics, not the other way around, right? You cannot throw out theory in favor of statistics, but that's what we've done. Now, my son, he's getting back from Taiwan next fall. He's going to be studying economics. He was going to go statistics. Is there really a difference? Not really, right? At the end of the day, economics today is 100% about what you can statistically reflect versus an actual theory that guides your policy. We've thrown theory and any sort of truth out in favor of what? Any statistical relationship I can create that people will accept. That sucks. Okay. I'm ashamed to be an economist. Everything I learned, I remember arguing quantity theory of money with an Austrian economist. Smart guy. I'm a better debater than he was, though. So I came out on top for the people there. And all right. But I was wrong. I was 100% wrong. It's back in 2003, 2004. All right. So let's get to gold here. So why is gold taking off here? Because there is dollar divestment. Dollar divestment can go into dollar denominated assets. This is gold in dollars. This is not gold in loaves of bread or pairs of shoes, right? This is gold in dollar terms. So as we exchange dollar for gold, guess what happened? Gold goes higher, dollar goes down. It's reflective of the divestiture, the pressure in the global system right now. And we have upped the ante, right, in the last few weeks in the geopolitical realm, haven't we? We have had a little bit more saber rattling, haven't we? We did see oil pop here, didn't we, yesterday? Break out the last several days as we're doing what? As we're kind of engaging in the Middle East, as we're engaging in Greenland. You may like the policy, you may not like the policy. Doesn't really matter, does it? We are seeing a direct effect and we are people selling dollars. But the problem is that is not going to happen forever, as I've shared, right? The one-way street in dollar selling ends where? Where does the one-way street in dollar selling end? It ends with what? It ends with a collapse in credit. Why? Why does a collapse in credit ostensibly lead to a strength in the dollar? Why are those two things tied together? Because remember, right? We're a debt-based economy. We expand our money supply through debt. When that debt gets marked to market and it starts to decline, guess what happens? Demand for dollars go up and the supply of dollars goes down. Demand goes up because there's a substantial amount of dollar-denominated debt out there. Foreign holders of debt that has to be repaid in dollars. This is a result of what? Our financial system, where countries hold on to dollar reserves, right? And that is not going away right now. So the fact of the matter is we're seeing leverage, and I talked about the paper market in gold yesterday happening right now. Understand that when that leverage comes out, what are we destroying? We're destroying credit, right? Inevitably, we're going to see exactly how far gold can go as we unwind the leverage in the system. Then we're going to get a sense of what the true relationship is to dollar to gold. What we're destroying right now is the paper market. This is the paper market for gold, right? It's the paper market for silver. This is what we're seeing come out right now. But yesterday, the options market told us exactly where we stood in gold. We looked at GLD yesterday. We were looking at trade in GLD, option trades. And what we saw was, certainly we saw a big bullish trade in gold yesterday. And I can't remember the specific strike price. I'll just generalize it here. I can't remember what expiration it was, but they were buying way out of the money. Now it's way out of the money. Let's get out here. But they were just buying way out of the money call spreads, like buying here and selling way out here. Why were they doing that? Because they wanted a lower risk trade on gold. The problem was the gamma effect is minimal. Implied volatility IV percentile was at what? It was 100 percentile. It's the highest it's been all year. Options are expensive. Spreads, the skew was flattening yesterday. So you had to go further out of the money and expand the spread between your strike prices. We saw that in silver. There was no real mechanism for the gamma squeeze in gold and silver to remain. The options market told us that yesterday. When we looked at the trade in gold yesterday, that's exactly the discussion that we had. So if I go, that's yesterday right here. Let's look at gold. GLD. Looking some up for Professor today. Vol alert, right? Got which one it was here. Yeah, it was right here. Is this call spread right there? 32,000 contracts, right? It's a call spread. They're buying the 45, 45s and selling. Oh, I can't remember what it was now. Where's the other part of that spread? 10 to, oh, it's right here. So they bought the 520s inside, sold the 545s. Why do you go 25? That's big typically for one of these these big spreads here. So 30,000, right? 30,000. Bought the 520s and had to spread it out because what? They had to reduce the cost through skew because we're at 100% IV percentile, right? That was yesterday. There was no mechanism to create an efficient, effective trade at all in gold yesterday or silver. This big spread that was put on was an abject failure from day one. And we spent time talking about that yesterday and the difficulty that gold was going to have here. So now we're down what? We're down 8.5%. Is it time to enter today? Do you catch the falling knife today in GLD? Yesterday, we were kind of down here yesterday, right? When we talked about gold. Do you catch the falling knife today? It's really hard to do. Why? Because we're just starting to see what? We're starting to see the leverage come out, and that's what I warned about yesterday. That's what we saw with the desperate trade that was put on in GLD. There was something similar in SLV as well. So right now, as we're seeing gold come off, we're going to find out where the unwind is. I heard someone say, I'm going to buy silver for my 401k. Really? SLV? Do you really want to get caught up in this? Where should silver really be? 45? This thing could get halved, right? So if you're thinking as a long-term investor, this is the time you want to step in. My goodness, what are you thinking? Okay. What are you thinking here? This is why yesterday I spent time talking about it, showing it, because this is exactly what I was expecting, but not knowing would happen, right? But I was showing the option trade and saying, if this was a gamma squeeze here, which it probably was, the gamma squeeze is cooked. The vol ramped up too high, too fast. And on top of that, we started to see some selling come in. It was flattening it out. It was flattening it out. Why? They're buying call spreads. They're buying one and selling another. So what's happening is that vol skew as IV rises as you go out of the money, as you buy here and you sell here, because you're seeing the skew, and the skew flattens out as volatility goes up. That's what we saw yesterday, right? That's what we talked about. And again, it's going to take out the one thing that was driving this stuff, and it's speculators, right? We saw the skew flatten out because they're trading verticals, which is exactly what I've been telling you to trade since back here. If you're going to buy silver, buy a call vertical. It's the only trade. And then up here, suddenly you couldn't even buy calls anymore. And the skew had flattened out because everyone was piling into that call vertical trade. And all of a sudden, the skew flattens and you have no edge unless you're going 25 points wide in GLD. And the volatility is pushing you way, way out of the money. That's the difficulty. So we can say we can't. It's absolutely not about, it's not about manipulation. This has nothing to do with manipulation. If you were a good trader, you did not own SLV here. I've been sharing this since right back here. And yes, I missed a good chunk of this move. So I didn't want to enter the fray. Certainly not for Ghost Prince, because any day you can see this and people don't like that, right? So I try to shelter, and you try to do the best you can. But when you see this kind of move, parabolic move, I struggle to go long those, and I don't want to go short it. But the point is, there was only one trade in this. The only trade that made sense were call verticals. Maybe some call options back here. But once the volatility had ramped up, the only thing left to do were verticals. And so at the end of the day, we just had to understand that the trade was wearing big time, right? Look at what's going back here in November. Vol was what? About 40%. We went over 100% here. So the point is, it's not about manipulation, right? We know there was a short squeeze in silver last year right there. Yes, there's a squeeze. Is that manipulation? Absolutely not. But the driver here was about speculation, and you see it right there. Buying calls. It's called a gamma squeeze. But yesterday we saw the big indication. Look, this gravy train is over. It's done. Vol went too far, too fast. Yes, all of the speculators out there buying calls on it. It cannot fail. It's the only game in town. It failed. But again, if we're looking objectively, we're looking at the volatility, it tells us how they're positioning themselves. And the big trade, they were buying call verticals, right? They were buying call verticals. It flattened out the skew, and we saw incremental option buying as well. And we suddenly go to 100%, and we have flat skew unless you're getting way, way out of the money, and you got to spread your strikes out wide to even benefit. I'm spending too much long on this, but does this make sense? So that's why I spent so much time on gold and silver yesterday, because you could see it in the options market. You could see this sucker ready to explode yesterday and not to the upside. So I hope I made that clear yesterday, and just realize there could be a lot of pain here because we've lost the one driver that really took it from 63 to 110. It's done. All right, let's talk about BZ. Let's get to the happy, cheery stuff. Now, I love talking Fed. Again, here's the deal, right? A lot of people, when they talk about this stuff, they get caught up in the minutia, right? Is that how you spell minutia? I don't think it's M-I-N. I don't know how to spell minutia. They get caught up in the little details, right? They're too academic. Academics and understanding policy, you will fail, right? If you're trying to use academic type stuff and trying to interpret, all you're talking about is statistics, right? So if all you're doing is showing academic papers, we're talking about academic, what you're telling me is you have no foundational theory, right? And it's theory that has to guide your policy. There we go. You're right. Should have known that, J9. Thank you. Right? You have to have a theory. It cannot be all loose statistical correlations. You have to have a grounding in theory. If you don't, you'll always miss the mark. Or at least if you hit the mark, you're doing it accidentally. All right. Now, Don talked extensively this morning about what? What did Don talk extensively this morning? Actually, it's been his coaching session the last 2 days. He wants to talk edge, right? Edge. So we just talked about how to interpret yesterday, how to interpret gold and silver, GLD, SLV, by virtue of looking at what? Option implied volatility, right? Risk and probability. Risk and probability relate to what? Edge, right? Probability, risk, and reward. That's how you calculate your edge, right? Everything comes down to edge. You have to understand where your edge is in the market. And edge is a function of little probability row, risk, and reward. Those are kind of your three factors to consider in constructing some sort of edge. But the problem is the edge that you see sometimes is temporary. So I've talked about Fed policy because we're going down to what? The concept of theory, right? We have to have an underlying theory that is creating our edge. It cannot be loose statistical relationships. What am I talking about? Backtesting, right? Can you really understand edge through backtesting? The answer is no, right? Backtesting cannot fully explain edge. Because here's the thing, backtesting is frequently based on what? Take a set of indicators, a set of rules, and apply it against all stocks equally, right? And see if there's a statistical statistical profit over a period of time that's produced, right? So strictly back testing, looking at indicators, cannot therefore fully guarantee any sort of edge. And then if I trade options, the question is, can I find an edge in the options? You can, even if you had an edge based on price, you can quickly lose that edge if you don't know how to trade options. Okay. If you do everything indiscriminately, if you have one hammer and everything looks like a nail, any edge you perceive in the equity can be lost in the options. So I could give an absolute theory on gold and silver and why they should be going higher, right? And why they may continue higher. But I have to understand, if I don't have an edge in trading, how do I capitalize on that theory? I can't. So let's turn our attention to VZ today. So in our Ghost Prince chat and our Ghost Signals chat, I shared a trade yesterday about 25 minutes before the close was on VZ. Now, VZ was on something very specific, okay? An area where I feel that there is edge, okay? Theoretically. And then we have to ensure that I have a actual option trade edge in that as well. All right, so I'm looking at VZ yesterday, okay? This actually was alert time was about 2:48, so we're about an hour and 10 minutes before the close, okay? So I catch it about 25 minutes before the close. And I see, wow, someone just bought 17,000 call option contracts. And I can look right here and I can see they did it in what? They bought 13,000 in one print and another 30. Oh, it's today, sorry. They bought 17,555 contracts in one trade. Who buys 17,000 contracts in one trade on VZ the day, literally an hour and a half before they're about to go before they're going to announce earnings? And yes, they didn't buy a Friday. They buy a 4150 call here. All right, let's go back here. Who buys? It's a February 20th. We're a month out. We're 20 something days out, 21 days out. They buy 17,000 call option contracts at 4150. Not me either, right? None of us are buying 17,000 contracts at 4150. Did somebody know something? I don't care, right? It doesn't matter. We do not look at the motivations of why they're buying it. We only look at the effect. And who does it affect more than it? It affects the market maker, right? If they're buying 17,000 call option contracts there an hour and a half before the stock closes for trading of the day and they have earnings, there's nobody out there they're able to match up with that's selling 17,000 contracts. The market maker was on the hook for 17K, right? They were on the hook for 70 at 4150. Now, we've talked about this idea of a gamma wall and a gamma squeeze. What is this going to create? A gamma wall or a gamma squeeze at 41.5? Which one? Yesterday's print of 17,000 call contracts bought at 4150. Is it going to create a gamma wall or a gamma squeeze at or above 4150? Tim says squeeze because they bought. Joe says squeeze. Yes, it creates a gamma squeeze. Now, I'm in a bit of a precarious position, right? Because I traded a butterfly. I sold two of the 4150s. I bought a 40 and sold a 43 for 35 cents. So selling two here, so I understand, look, there's the potential for a squeeze here, right? There's absolutely 100% a potential that if we go 241.5, we could squeeze. My hope was we wouldn't squeeze too much or we'd open up about 41.5. But I frequently will use the contract traded as a means of identifying my target for the stock. And so I felt, okay, 41.50. Okay, if I sell two there, I buy 143, I sell 40. We have a good chance of gapping up into this range. And then my hopes was I'd be able to get out because I also understood there's potential for a gamma squeeze. Now, I could have decided yesterday just to do the vertical, right? A vertical for today's expiration. And to be honest, that would have worked out pretty well. If I bought a 40 and sold a 41 and a half or sold a 42, man, I'd be talking about max gain. But if I bought a 40 yesterday and sold a 42, the skews was against me a little bit because the 42 was, I guess I didn't look at that part of it. Let's go look yesterday. Analyze VZ. We'll look at think back. I haven't restarted the console. I haven't restarted the platform for a while, so I don't have the most frequent, most recent tape. But my guess, skew is going to be against me, right? So I didn't look at it because I was like, skew's likely against me to buy a 40, sell a 42. Now I'm something where I've lost my edge. But volatility yesterday was really, really high in the front week, right? In fact, the expected move, yeah, anyway. The point being is the vol was really, really high yesterday. So it allowed me to cast a pretty dang wide net between 40 and 43 for 35 cents. And I just targeted that strike price to trade, knowing we could squeeze, but feeling like, okay, right off the open, I have a chance to get out, right? And probably have a very high probability of making profit, especially even if it maybe moves a little more before all the vol rips out of it. I got really, really nervous because it was either think or swim, or maybe the options market did not open right away. I'm trying to get filled. We're here at 41.40 at the low. We're dropping right towards 41.50. And I'm right here and I'm trying to get an order off. The issue, the platform was not updating, or the option market delayed its open by a matter of like 30 seconds or more. And I did not get a quote until the next bar right there, and the thing starts ripping. So then all of a sudden I go from being, I could maybe close this thing for like 90 cents, $1 maybe, paid 35 cents for it. My maximum gain's $1.15. All of a sudden, man, I might be able to get $1 down here. I'm sitting right at the money at expiration on expiration day, getting the vol crush, and I can't get a single quote to send my order off until we get to the next bar and the sucker starts ripping. And it's going so fast, you can't get a fill. I tried 86 cents. Mistake, right? I went a little bit below the mid. The thing keeps ripping higher, right? Keeps ripping higher until we get up here. And then we ease back a little bit. Volatility start to come in. I got filled at 68. Okay. So the thing is, even if you're right, option, again, the trade still doesn't let you do. So my theory is 100% correct in this circumstance on VZ. Expecting they buy tons of calls, that the risk is to the upside. 41.50 is the strike. It may create a gamma squeeze. All of that played out. The bullish response, the gamma squeeze, and everything, right? I still was on the verge of not being able to capture it as a profit. Why? Because of liquidity, because data delay. So instead of getting 96, I think I tried for 92 and 86, and all of a sudden I get filled to 68. Now, again, it's still a 94% gain in one day. But sometimes the market, and we actually get down to the actual trade and liquidity, all of these factors, sometimes all have to come in alignment to make a profit. And so again, the theory played out exactly perfectly. The practice of trading sometimes doesn't. Yeah. And maybe it's platform issues. I don't know. Could be a Schwab thing, possibly. And I traded this in Think or Swim instead of Tasty. But anyway, yeah. And so again, these are all things. And in order to make money, both those factors have to come together, right? So can we always get it right in terms of market liquidity? The answer is no, we can't, right? This isn't trading what we call slippage. Slippage happens. I can't even spell slippage right. Slippage happens, right? We cannot account for slippage, right? Well, we can't account for it. We just can't guarantee it doesn't occur. So we have to find edge everywhere we can. And so when I talk about gamma squeezes, things like that, this is something that is baked into the cake. All we need is just a little bit of movement to and through. This is what happens. Lots of earnings examples recently where the option activity played out exactly the way you did it. And we talked about VFC earlier in the week. It played exactly out as what? This circumstance, the gamma wall was at 17, right? The gamma wall was at 17. We have a little potential to squeeze. Look what happened. Why did VFC, and I can pass it to Corey, why did VFC drop like this only to recover the next day? How can you explain it theoretically? We do have a perfect theory in this circumstance. It's called gamma. It's 100% gamma, right? It drove us down, and then we were finally able to kind of release the gamma, and all of a sudden, boom, we're allowed to go back up again, right? Gamma has a very direct observable effect. It creates edge. So we have to maintain edge in the actual analysis. We have to maintain edge in the actual trading strategy. And guess where we lose edge? We lose edge trying to fill, right? That's called slippage. So we gotta get as much edge as we can here, because you're gonna lose it when you're actually trying to get in and out of your trades, right, Corey?
You just gave me the title of my session today, which is Release the Gamma.
Oh my goodness. Release the Kraken. But gamma, we saw there was the other day, and again, it's all about where's the bigger movement occur. So right at the peak up there, we had a pretty significant. Let's stop sharing here, I think. Or you're sharing now. Where am I going? I guess stop sharing. We saw a pretty significant number of put options being bought at the peak on the 28th. We talked about it here, and realizing that the bigger move right now in the S&P is to the downside. We still have to go down to trip the trigger of gamma, but at the end of the day, it's gamma. And that's
my slide. You see my slide, Brandon?
There you go. Release the gamma. and that's people.
It's true. You're exactly correct, and that's we're trading price action, we're trading probabilities, and gamma's order flow. It's money flow. These things cause the action, and that's what we trade. It's what the risk is and the reward is. It's absolutely correct.
And specifically, the gamma is a source from options, right?
Yeah.
So
gamma, as I learned when I was a kid, gamma hits the delta, and then delta is your profit or loss in the option there. Well, how quickly the profit and loss goes.
Yep.
Or I think I learned as gamma slams the delta is what I heard it as.
Well, it depends. So if you have a put trade, for example, that's positive gamma, because if you go down one, it increases the negative delta. And so I was kind of explaining the other day, look, this is not about the intent of the traders. It's about the market makers positioning. And the gamma is their positioning, and the effect of gamma on the market makers is what's driving price in a lot of circumstances. And then obviously you get the piling on effect too, but
that little squeeze.
Yep.
All over the place. And this is true in intraday, but largely on the option market, how you can look at the ghost print scans that you do and how that does very well to point out these opportunities. And that's just looking at the option maker positioning, and there's a lot of advantage to that.
Yeah, and Don does a good job talking about gamma in the bigger picture. So you get to stocks like Tesla or Apple, that kind of stuff. A lot of times you're not going to source an individual option trade that's really going to shift your probability and gain an edge. It's really in the aggregate positioning mostly. And so Don does a good job at really talking about that aggregate positioning using the option statistics page and helping driving price. And he trades off that using the 0DT stuff. Ours is different. We're kind of focused on, yes, we might see a big trade in Tesla, but we're talking about 17,000 contracts in VZ. It's an entirely different thing, or VFC. It's an entirely different thing than seeing 17,000 contracts in NVIDIA. So there has to be a little bit of nuanced interpretation for doing it. But looking at the bigger aggregate gamma, or you're seeing like 100,000, 200,000, 400,000 contracts traded on the SPY, now you can see, okay, gamma can play out. So anyway.
Well, it depends on that happened too. And with PE ratios, again, I'm going back to my childhood here, but I'm a child in the market. When you look at PE ratios, similar to gamma squeeze, option statistics or how much volume takes place on a daily basis, you can say, hey, wow, 1 million contracts took place. But what if the average is 10? And that's pretty anemic. Or if the average is 1 million and you see 10 million, whatever the numbers are, that's significant. So the same thing with PE ratios. This has an enormously high PE ratio. But if all the tech sector or all a particular sector has similarly high PE ratios, it's not that far out of the mean at that point. So it's context and putting it where similar comparisons are with gamma and different little statistics on option volatility and the like is really important. That's a good point.
And that's something you saw yesterday in gold. It's like, yes, you could provide a theoretical basis for why you think gold prices will keep going to infinity. But there's also limitations. And if we understand the driver for gold, and we understand yesterday, man, vol at 100% IV percentile, the skew's flat, and any advantage is gone. We've lost the gamma driver for gold and silver yesterday. I spent some time talking about that today. So I like the fact we're down today because we may want to get back in at some point. But number two, I like to see the theory play out. That's something happening with gold and silver. So
That's me too. I like when the models work, and I like the bull case, the bull side. But when the models work, and that's how we make decisions as traders.
Yep. All right, have a good one, Corey. See you, folks. Thanks for joining me.
All right, thanks, Brendan. Have a good weekend. We'll do about